Remember the name Ketan Parekh? He just refuses to go out of the headlines. Parekh has just been banned from traveling to countries like the UK, UAE, Qatar, Singapore, and Thailand for 4 months. Why? Because the special SEBI court said that Parekh allegedly indulged in illegal securities activity affecting national interest. Ketan Parekh's story spans 3 decades, multiple investigations, SEBI orders, and larger questions of the securities law. And in this edition of Everybody's Business, I bring to you this story of Ketan Parekh, also known by many as KP. To give you the complete picture, let's start right from the beginning. Ketan Parekh was born in a Gujarati family of stockbrokers in the year 1963. He's a chartered accountant by training. We've all seen images and TV visuals of the lanky, tall man who has tried his best to maintain a low profile. Which also explains why there aren't many recent images or videos of Parekh that are publicly available. Parekh, who has in the past been described as the Pied Piper of Dalal Street, can be called a trainee of Harshad Mehta. Again, we've all heard of that name, right? He's also a part of Parekh's story, and we'll talk about him in just a bit. Ketan Parekh first rose to prominence in the late 1990s during the tech and media boom when he was seen as a market wizard who could spot and move high-growth stocks. Those who dealt with him in the 1990s described him as a methodical, persuasive, and exceptionally well-connected man in Mumbai's trading circles. He was known to be soft-spoken and somewhat reclusive, and when his name first surfaced in financial wrongdoings in 2001, many people were left surprised. Though Ketan Parekh is known as the man who followed Harshad Mehta, he was quite unlike him. Harshad Mehta was known for his expensive and flamboyant lifestyle. He had a sprawling penthouse in a posh Mumbai locality and dozens of fancy cars. He too was born in a Gujarati family. Mehta completed his BCom in 1976 and within a few years started his asset management firm, and by the early 1990s he was heavily trading in shares. Now, Mehta is said to have exploited loopholes in India's banking system to divert huge sums of money into the stock market. He allegedly used fake bank receipts and unsecured interbank transactions to siphon funds from banks and pump them into select shares, driving up the prices. His trades created an artificial bull run and he became a celebrity investor very quickly. Between 1990 and 1992, the media often called him the Big Bull. Mehta's undoing came when journalist Sucheta Dalal exposed how he manipulated the banking system to fuel his bets. Once banks demanded their money back and the markets corrected themselves, that bubble burst. On December 31, 2001, 47-year-old Mehta died at the Thane Civil Hospital while in custody. He is said to have complained of chest pain right before his death. Both Harshad Mehta and Ketan Parekh's stories exposed several loopholes in India's financial system and became the base for major reforms in the sector. And now, let's shift our focus back to Ketan Parekh's story. There are many layers to it, and we'll try to lift them all one by one. We'll talk about a 67-page SEBI order from 2003 that banned Parekh from trading for 14 years, a 188-page interim order from January this year on allegations of front-running by Parekh, a new 7-page SEBI court order banning him from travel abroad, and a host of other developments around them. After the Harshad Mehta episode in the 1990s, the Indian stock market was fragile and companies were struggling to raise funds. A vacuum was created and the economy was also going through a rough patch. And hence, bank financing and liquidity became an issue. Ketan Parekh was an up-and-coming trader at this point and many promoters turned to him. Parekh promised to lift their share prices, unlocking liquidity for them. And according to the 2003 SEBI report, he did this while making a fortune for himself. He is alleged to have used something called circular trading, where stocks are shuffled within the same group to create an illusion of demand and inflate prices. Parekh rode the dot-com bubble and IT boom, the advent of ICE or information technology, communication and entertainment, and mostly relied on about 10 companies to operate. And these companies came to be known as the K10 stocks. These were DSQ Software, Ranbaxy, Pentamedia Graphics, Global Telesystems, Z Telefilms, HFCL, GTL, SSI, Silverline, Aftec, and Infosys. He occasionally also operated in 2-3 other companies. And what did he do with them? SEBI says that Parekh used heavy volumes of money to move or manipulate the market for undue gains. He received money from company promoters, foreign corporates, and cooperative banks. Investigations showed that he borrowed crores of rupees from Global Trust Bank and Madhavpura Mercantile Cooperative Bank. These transactions were said to have violated RBI norms. Now, by artificially propping up the prices, Parekh allegedly attracted institutional investors like UTI and LIC to buy at inflated valuations and then exited at a profit. And this left small investors struggling with losses. Let's take an example. The share price of VisualSoft skyrocketed from 625 rupees per share to 8,448 rupees per share. Another example is Sonata Software, whose share price rose from 90 rupees per share to 2,150 rupees per share. SEBI says that Parekh would inflate the prices of the Ketan stocks by illegal means like insider trading and circular trading. Now, the 2003 SEBI report says that Ketan Parekh and his associated entities, Classic Credit Limited, Panther FinCap and Management Services Limited, and Sai Mangal Invest Trade Limited, had manipulated the price of Lupin Laboratories Limited shares during September and December 1999 through synchronized trades and circular trading. While Parekh and his accomplices were operating in this fashion, the dot-com bubble burst soon after the year 2000. And this is when Ketan Parekh's empire began to crumble. The collapse of the dot-com bubble wiped out valuations of technology and telecom firms, basically some of the very K10 stocks he had pumped. Prices began sliding, and his strategy of propping them up with borrowed money eventually became a trap for him. And the final blow for him came right after the union budget in 2001. A group of traders called the Bear Cartel, and also nicknamed KP Down, started short-selling Parekh's go-to stocks like Z Telefilms, HFCL, and Global Telesystems. And as these shares crashed, Parekh ran into a payments crisis. But he didn't stop there. He borrowed heavily from Madhavpura Mercantile Cooperative Bank and Global Trust Bank, using pay orders worth hundreds of crores. But when these bounced, Bank of India filed a criminal case. Madhavpura collapsed, Global Trust had to be merged, and Parekh was exposed, arrested, and eventually banned. SEBI concluded that their actions violated the SEBI regulations of 1995 and ordered restrictions on their market activities under Regulation 11 to protect market integrity. The CBI arrested Parekh in connection with the Bank of India's criminal complaint. In 2006, the Securities Appellate Tribunal dismissed an appeal by Parekh and his associated companies against the SEBI order, banning him from the markets for 14 years. He was given 2 years of rigorous imprisonment for committing fraud in 2008. The Harshad Mehta and Ketan Parekh episodes exposed loopholes in India's financial system and triggered major reforms. Mehta's misuse of bank funds in the early 1990s ushered in the SEBI Act of 1992, giving the regulator statutory powers. It also triggered banking reforms like the Narasimhan Committee, but Parekh's actions with Ketan stocks a decade later showed that gaps still remained. This led to the SEBI Amendment Act of 2002, which strengthened SEBI's enforcement powers, among other things. And that, in a way, marked the end of the first infamous chapter in the Ketan Parekh saga. And the next big development linked to him came earlier this year. On January 2, SEBI alleged that Parekh and 21 others made about 66 crore rupees in illegal trade gains by using insider information from an unnamed overseas entity. It said in an interim order that Parekh benefited from using information about trades planned by a big client that was not public. The SEBI said that its investigation was for the period between January 1, 2021 and June 20, 2023. It said that it would recover 65.8 crore rupees of unlawful gain earned from the alleged violations and barred Parekh and 2 others from dealing in securities for an unspecified period. Parekh was trading independently at the time, and SEBI said that he organized the trading scheme in which 21 other people were also involved. I quote from the order. Based on the evidence collected during the search and seizure operation, it was prima facie suspected that in addition to traditional front-running, the front-runners used complex trading strategies to take advantage of the prior knowledge of the impending trades by the big client. Front-running is the trading of stocks or assets based on insider knowledge of a future transaction. We had done an episode of Everybody's Business on it, and you can watch it at the link shared in the description box. An analysis of the 2025 SEBI report shows that Parekh's latest run-in with the markets has the signature of his old playbook. And what was said in this report is also linked to the SEBI court's order banning Parekh from foreign travel. SEBI says that this whole play revolved around a big client, a US-based fund house placing big trades in Indian markets. A person named Rohit Salgaonkar, who had access to the big client's plans, leaked this non-public information to Parekh. Parekh would then direct his network of brokers to trade just ahead of the client, a classic case of front-running. For example, when the big client was about to sell lakhs of shares in Policy Bazaar, Parekh's people had already taken positions. Within minutes, they make quick, risk-free profits. The SEBI report says that Parekh, whose previous ban ended in 2017, was secretly conducting trades using WhatsApp groups. It said that prior to execution of suspicious trades, front-runners were receiving trade instructions through WhatsApp chats or calls from a person whose contact numbers were saved as Jack, Jack New, Jack Latest, New Boss, etc. Upon analysis of these contact numbers, it was found that these numbers belonged to Ketan Parekh, who was receiving information from Rohit Salgaonkar. After receiving specific and timely instructions directly or indirectly from Ketan Parekh, the front-runners used to execute orders and made unjust profits. In one instance, nearly 12.7 lakh rupees was made in a single day by matching just under 40% of the big clients' orders. Over time, this network generated unlawful gains of nearly 38.7 crore rupees, according to the report. Parekh not only controlled the trades, but also shared profits through cash and bank transfers with his brokers and facilitators. In essence, Ketan Parekh was alleged to be still manipulating his way to wealth, only this time not through open market rigging, but by exploiting insider information of large foreign trades, turning WhatsApp groups into his new trading floor. From the backup of the mobile devices found and seized during search and seizure operations and the subsequent statement recordings of various entities, contact details of Ketan Parekh were gathered. It was noted that in none of the mobile phones were the contact numbers saved in the name of Ketan Parekh. Instead, various monikers such as Jack, John, Boss, Bhai, Well-wisher, etc. were used to save these numbers. And it was these WhatsApp dealings that the SEBI referred to while opposing Parekh's travel in court. Let's now look at the court order. Ketan Parekh had sought permission from the court to travel to the UK, UAE, Qatar, Singapore, Thailand, Sri Lanka, South Africa, European Union, and Georgia from October 4 this year to February 3 next year, basically a 4-month period. He said that this was for a family vacation and to attend 2 wedding ceremonies of close relatives. He said he was going to furnish the itinerary before travel. He also mentioned that he had previously been allowed to travel abroad, which is a fact. The SEBI, on the other hand, said that there were several criminal cases pending against him before the court, and that Parekh had not shared details of the tour, that a blanket application was filed seeking permission. It said that during an earlier travel period, he had violated the SEBI rules. It said that he had used travel permission as a cloak to disguise illegal activity, and that there was every possibility of him misusing a possible travel permission again. The regulator said that it would not be in national interest and the interest of the economy to permit Parekh's travel abroad. Now, Parekh was previously granted permission between January 2021 and June 2023. The prosecution said that it was objecting this time because Parekh and others wrongfully gained 65.77 crore rupees by violating SEBI Act provisions between January 2021 and June 2023. Ketan Parekh's story is not just about one man's repeated run-ins with the law. It's about how India's financial markets have evolved, stumbled, and learned to guard themselves. Each time he appeared in SEBI's orders or in a courtroom, the system had to tighten a few more screws. From the circular trades of the 1990s to the front-running allegations of 2025, his name has also shadowed the maturing of India's market regulations.